Okay, thanks everyone for joining the team representing BDH Sterling today as we present to you a great session outlining how to unlock your UK pension potential in Australia and smart strategies for expats. During the session, we'll share information and considerations around the types of pensions and where it may be possible to transfer and the logistics around doing so. The tips and traps around the process of undertaking a transfer and why it's necessary to gain advice to look at such transfers. This is due to the complexity and also for how you want to make the most benefit of the funds in conjunction with overall financial planning needs. Today's session will be information only, general information only. So it's based on UK and Australian legislation as of the 22nd of November. It is general information. It's not tailored advice specific to your situation. So before acting on any of the information contained in today's session, we'd encourage you to seek advice, financial advice from a suitably qualified financial planner. Today, you'll have myself, Brenton Ritchie. I'm the Financial Planning Manager for the Australian division of our business. I'll be helping facilitate today's session and assist with the Q&A at the end. Joining me today is Senior Financial Planner Nick Bond. Nick's been with BDH Sterling since inception and brings fantastic industry experience and knowledge with advice strategies across UK and Australian clients, and will today share with us his knowledge across both those jurisdictions. He's got the tough job today of taking us through the main content you need to know about making the right decisions about your UK pension in Australia. So we've broken today's session into 5 key areas. The first being the types of pensions and why it might be worthwhile to transfer. QROPS, so what is a qualified recognised overseas pension scheme? The transfer process, what it takes to transfer across and why advice is important in that process. BDH Sterling, so a little bit about who we are, where we can help, how we can assist, and then the Q&A. We've absolutely left time at the end to answer questions you may have, so please feel free as we go through the session. In the Q&A button there, please put your questions in there and we'll try and answer as many as possible as we can. If we don't get through all the questions, we'll come back with any specific answers to questions you have asked post the webinar. So let's get started. Let's look at the first section there, which is the types of pensions and why transfer, and we'll hand you over to Nick.
Thanks, Brenton, and thank you everyone for joining us today. So as Brenton said, I'm going to run you through the types of pensions and why you may consider transferring. So in the UK, there are 2 types of pension schemes. We have defined contribution schemes. So to give you a comparison to an Australian scheme, if you have a super fund, be very similar to the majority of super funds that are out there. Contributions made by the members and or employers, and what you're invested in and how well that performs over time will determine the fund value, and that value will change on a regular basis. The names you might have heard that you might be familiar with, personal pension or SIP, self-invested personal pension, or group personal pension. So they're defined contribution schemes. The other type is a defined benefit scheme. So you may also know them as a final salary scheme or average earnings scheme. And that is based on how many years you worked for your employer and what the salary was when you left, or what the average salary was over the course of time that you were with the employer. You don't have a transfer, a fund value per se. You will have a pension income. So every year, your employer has promised to pay you a pension income once you're at the normal retirement age of the scheme, and that is the value. But if someone's looking to transfer, they will calculate a cash equivalent transfer value to pay out that benefit, as opposed to giving you a pension income over time. The valuations have a 3-month expiry period, so they're calculated by an actuary. Excuse me, calculated by an actuary, and that valuation will expire after 3 months if you haven't acted. You have to get all the paperwork back to the scheme within that period to be able to accept the value that they've given you, should you wish to do so. So what types of pensions can be transferred? So some can and some can't, and I'll run through that now. So UK company pensions, defined benefit schemes, defined contribution schemes, so self-invested personal pensions, funded public sector defined benefit A good example of this would be a local government scheme, if you work for the local government in your area. Any other QROP schemes, so it might not be in Australia, it might be in another country like Malta or Gibraltar, they can be transferred. And QNUPs, qualifying non-UK pension schemes, they can also be transferred. So moving on to what can't be transferred, the UK state pension, that you won't be able to get a lump sum for that. You will get paid an income from the Department of Work and Pensions once you reach the state pension age. And you can get it transferred directly into an Australian bank account if you please, but you physically can't get a capital value for that amount. It will continue to be paid as an income throughout your life. Any government unfunded defined benefit schemes, so NHS, police, armed forces, civil service, there's quite a number of them. Those unfunded ones cannot be transferred overseas. They will stay in the UK. You will receive a pension from the company or institution, and that will be paid out throughout your retirement. Any of the company pensions, so private defined benefit schemes or the local government pension scheme, they cannot be, if they've gone into the pension protection fund, which the local government pension scheme won't have done, but something like BP or an ASDA or a big company in the UK, if they were to run into trouble and be able to be unable to fund pension income, the government step in and push it into the pension protection fund to protect all the members. Once it's in the pension protection fund, that can no longer be transferred. Excuse me. Any annuities that have been purchased with a life insurance company in the UK, so if they're in payment or deferred, you can't transfer those once they've been set up. So what in order to transfer to an Australian superannuation fund, the UK pension has to go into a QROP scheme in Australia. There are only two options. One is a self-managed super fund, an SMSF. The other is a retail scheme that anyone, as public offer fund, that anyone can join if they're over the age of 55. So the scheme has reporting requirements to HMRC in order for them to be a recognised overseas pension scheme. The reporting period from date of transfer is 10 years. So every year, if there are trigger events that are met, then the scheme must report those to HMRC. The scheme is also must make sure that the benefits that one receives within the super fund are broadly in line with what the UK scheme provisions would be. Okay, so an example of that is if you wanted to buy a property in a super fund, you couldn't do that in an Australian QROP scheme because you can't do that in a UK pension fund. There's also a member payment provision period, which is 5 years. So there are restrictions within that 5 years on certain aspects of what you can and can't do. So that needs to be adhered to as well. So why transferring UK pension may not be suitable? So we'll start off with the reasons why not to do it. For a defined benefit scheme, the Financial Conduct Authority in the UK, they insist that you must take advice if the transfer value is over £30,000, and they are trying to protect the members from doing something that may not be in their best interest. So the FCA's starting position is that the defined benefit scheme transfer would be unsuitable. It's then the advisor's job working with the client to determine if it is suitable to do that based on the individual circumstances, such as the tax effective nature of superannuation in Australia, to name one. However, it's not always tax effective. It can be better to leave it in the scheme, draw it out, and you might be under the nil rate tax threshold both in the UK and Australia, so it might not be the best thing to do, and it's not always cost effective. It is expensive to bring the fund over. There's tax charges, which I'll explain shortly. And obviously taking the advice and running through the process is time, which obviously creates cost for the advice. The current UK scheme might be providing very good performance. There might be guaranteed fixed returns from older policies, and it may be too hard to match that in Australia, even with the tax effectiveness of superannuation. Some schemes, typically older schemes, have exit penalties if you leave before your retirement age or before a certain age, and that may reduce the transfer value that you may receive, and it may not be worth that reduction for the benefit of moving it to Australia. Particularly with the defined benefit scheme, there's going to be a switch of having no investment risk, which is all upon your employer to provide you with your pension income at your retirement age and then throughout retirement. If you were to transfer that and take the lump sum benefit, you would be undertaking long-term investment risk. So why should you consider transferring? One of the big points to consider is currency. From the graph, you can see that over the 5-year period that we have here in this graph, there's a lot of volatility. I myself have been working in this space for 17 odd years, and I've seen up to 2.7, so £1 buying $2.7. And when I first came to Australia, I saw £1 buying $1.45. So I've seen a lot of fluctuation, especially around events like Brexit, COVID, big global events that can cause either the pound to weaken or strengthen, or vice versa, the Aussie dollar to weaken or strengthen. So it's ideal if you can take that long-term currency risk out and understand what you've got in Australian dollars when you're in retirement, rather than it fluctuating over the course of your lifetime. Estate planning. So in the UK, there are tax implications from a UK pension if the member passes away post age 75. And to add to this, and we haven't put it in the slide yet because it's proposed legislation, but the recent budget proposed that pensions would now be caught up in the IHT net. So it could be a double whammy on the tax of if you die post 75, plus if you've got a reasonable fund size, or if you have any other assets in the UK, you could get caught up in the IHT net. More to come on that in the coming months. I just thought I'd put it out there because I'm sure some of you have seen that from the UK budget. Investment control. So if you do move the funds to something like an SMSF, you would have a wide range of choice of what you would like to invest in. Particularly if you're living in Australia, you want to ideally invest in a portfolio that is suitable for an Australian resident and keeping in line with Australian inflation, rather than having pounds in a UK pension that is going to be more akin to UK inflation. The tax treatment. So this is a very big one. So superannuation, as some of you might be aware, once you get to preservation age and you meet a condition of release, you can access your super fund tax-free. Then in terms of tax on transferring to Australia, it is only the growth since you arrived in Australia or back in Australia, if you're a returning resident or citizen. It's only that growth from when you arrived back in the country that is accessible to tax. And that tax rate is only at 15%, not marginal tax rate. So the tax treatment within super is very favourable, and the tax rate to transfer it is 15%, as opposed to drawing income from a UK pension scheme and paying tax at your marginal tax rates. The other point is a lot of people have multiple pensions from different employers and employment periods. So rather than having 3 or 4 dotted around in the UK, you would be able to transfer them to Australia and consolidate them all into one home, and hopefully reduce your fees overall, and hopefully be able to provide better long-term returns, because you'll be able to keep an eye on the investment a lot easier than you would if you were had many pension funds dotted around. Okay. Okay, tax on keeping the UK pension. So I touched on it very briefly just a minute ago. But if you have a UK pension fund and you're living in Australia, that income is going to be assessable. Firstly, it's accessible in the UK if you haven't completed or received a zero or an NT tax code. So the UK pension scheme will deduct tax at source until you've applied for the NT tax code. In any case, Australia, if you're a permanent resident or citizen, they will expect you to include your UK pension income on your Australian tax return, and you'll be taxed in line with Australian marginal rates. So even if there's tax been deducted in the UK, because of the double taxation agreement, you get recognition for that tax. So you're not paying tax twice, but the marginal rates in the UK and Australia differ. On top of that, if you've also got other pension income, other income from interest in the bank or personal investments, your tax rate in Australia will differ from your tax rate in the UK. So you might have to pay a top up in Australia if you don't have the NT tax code and you've been taxed in the UK. But point being, that income is taxable and taxed at marginal tax rates in Australia. In the UK, you are allowed to take 25% tax-free lump sum. This is tax-free from a UK perspective. However, the ATO will look to tax you on the growth of that lump sum from when you arrived to when you take that lump sum. And that will be at Australian marginal tax rates. So no tax deducted in the source at UK, it's tax-free, but Australia will tax you on the growth of that lump sum from when you arrived to when you draw that lump sum out. And yeah, another point to mention, lump sums can be potentially taxable in both countries. There are some lump sum payments that aren't tax-free in the UK, and tax will be deducted in the UK by HMRC, and then potentially also taxed by Australia or on the growth element of it. So making sure, if you do want to or need to take a lump sum in the UK, making sure you do it in the right way can save you a lot of money tax. Tax on transfer to Australia, as I touched on, the growth or applicable fund earnings, as it's known as, you're taxed on the date of arrival value versus the value when you bring the fund across. It's only taxed at 15%. That tax is paid by the super fund rather than the individual. So the super fund can pay it on your behalf to the ATO. So yeah, low rate of tax. Look, depending on how long you've been in the country, if you've been in the country 30 years, you will have built up a fair amount of growth. If you've been in the company 2, 3, 5 years, the growth won't be too high. So yes, the tax rate is pretty reasonable on that growth element. The remaining balance, or date of arrival value as we call it, that is tax-free. So no tax from HMRC, no tax from the ATO, but that date of arrival value or original capital, that is subject to the non-concessional contribution caps in Australia, which are $120,000 per year, or you can use 3 years worth in one go. So transfer options under age 55, we will provide scenarios for over 55s as well. And just a point to note, the age for which you can transfer or begin to take benefits from a UK pension is increasing to 57 from April 2028. So that will be age 57 from April 20. So yeah, what are your options if you're under 55, living in Australia and staying here permanently and want to retire in Australia? In the lead up to you attaining the age to transfer, you've got a couple of options. A lot of people would like to get their funds into a SIP, a self-invested personal pension. The benefit of being able to do that is that you're able to convert the funds into Australian dollars to take that future unknown currency risk out, particularly if the exchange rates are at a good level. People are quite keen to do that sooner rather than later. Or you could move them if you've got a few of them. You could consolidate them into one of the existing schemes or a totally separate private pension, just so it makes the ease of the transfer yeah, more slimline once you're at 55 if you've got one rather than five, or you can leave them exactly where they are in the current scheme and do nothing with them until you get closer to the age to be able to transfer. So what is a UK SIP? It's a personal pension, but it's similar to an SMSF, a self-managed super fund, whereby you have a lot more say in what you can do and a lot more flexibility than a standard off-the-shelf product. You're able to invest in anything that is allowable under legislation. So, for example, in the UK, a property private property purchase is not allowable, but you could invest in any stock markets, currency, whatever you please, whatever you like to invest in, you're able to do that within a self-invested personal pension. So what the benefits, as I mentioned, your pension can be denominated in GBP or AUD. So you're able to buy those dollars now or leave them in pounds if you please. And it can also be invested in pounds or dollars. So it's not going to sit there doing nothing whilst you're waiting for to hit 55 or 57. The other benefit is 100% of your pension passes to your beneficiaries tax-free if you pass away under the age of 75. Caveat to that, we don't, we're waiting to hear more about the budget announcements with it being caught up in the IHT net. And you can, yeah, have as much input as you like into the SIP. There are some SIPs that allow you to be fully in control and you make the calls. But if it's an advisor-led SIP or platform, it gives you a lot more choice in what the advisor can invest in. So on to a case study for someone under the age of 55. So John, 53, has two company pension schemes in the UK, totaling $350,000 that he would like to transfer to Australia. So what we would do in this instance, if it was suitable to transfer, we'll work all of that out when we're doing our due diligence for the report that we will provide you with. But what we would look to do if it is consolidate those two pensions into a personal pension or into a SIP. We would then convert the funds into Aussie dollars and we can invest that in Aussie dollars. So there is an option of investing in portfolios. There's options of cash or fixed interest options within Aussie dollars as well. Because John's got 2 years till he can move it. There'll be a decision and a conversation to make about how that investment is made. But point being, you can invest it in Aussie dollars. Once the age of 55 is attained, we will then assist with setting up the QROPS in Australia to receive the UK pension transfer, and then we will be able to commence that transfer in line with the NCC caps. Conveniently, John's funds under 360, so regardless of what the growth is, John can get this all across because he's under that 360 NCC cap using the bring forward provision. Transfer options over the age of 55. So, yeah, same applies. You would transfer to QROPS scheme once you're over the age of 55, and it must be within the non-concessional contribution limits, or you might decide to leave your pension where it is in the UK and draw it from a UK pension scheme. Okay, section 2 onto QROPS. We will do a run through of someone who's over 55 and the transfer strategy shortly, but I'll explain about QROPS first. So what is qualifying recognised overseas pension scheme? HMRC have actually dropped the Q now. It's now a ROPS, a recognised overseas pension scheme, but we've kept it as this because that's what most people are aware of and know the acronym for of QROPS. It was introduced in April 2006, largely brought about by the Freedom of Movement Act within the EU, which obviously the UK are no longer party to, but QROPS still exists nonetheless. And it's an overseas pension scheme that meets the requirements by HMRC to allow you to transfer that UK pension scheme to an overseas pension scheme. So they're making sure that it's going to the right place. It's the rules are mirror as closely as they can to UK rules. So yes, they want to make sure that you're not moving it to somewhere where it's going to disappear. They're trying to keep an eye on you and make sure you're doing the right thing. So yeah, QROPS is a great option for those that have left the UK permanently and intend to retire abroad if you've built up a UK pension over that time. So legislation changes. This is a moving target all of the time, but we've highlighted a couple of the big points in the last 10 years or so that have occurred. In April 2015, the government announced that you'd no longer be able to transfer unfunded schemes. You might recall earlier I mentioned the NHS, police, fire service, armed forces. They're all unfunded schemes. Prior to 2015, you could transfer them, but as of April 2015, that was no longer allowed. At pretty much the same time, HMRC introduced the pension age test, and as a result of that, prior to that date, almost every super fund, excuse me, in Australia was a QROP scheme and able to accept UK transfers. Post April 2015, they were all removed from the QROPS list, and it took a little while for the retail scheme to be put on there, and also to work out that SMSFs would be the vehicle upon which to transfer as another option. So yes, it made it a lot harder overnight, quite literally, for pension transfers to go ahead. And as I mentioned previously, an FCA licensed advisor, you are required, if you have a transfer value for a defined benefit scheme, which is over £30,000, you have to have advice from someone like us that has the relevant permissions from the Financial Conduct Authority to provide that advice. Even if you're adamant you want to transfer, you must take advice. It's not possible to do it without that advice. In 2017, again, quite literally overnight, the overseas transfer charge was implemented. So that's a 25% tax charge if you transfer to a jurisdiction that you are not a resident of. Prior to that, you could have, for example, been living in Australia, have a UK pension, and have transferred to New Zealand or Malta or Jersey or wherever you wanted to, but yeah, when that transfer charge came in, it made it a lot less appealing for someone to move it to a jurisdiction that they didn't reside in. Contribution caps changed in July 17, so from an ATO perspective or government perspective, they reduced the non-concessional contribution caps, which was previously 180. Dropped down to 100 from memory. That has increased slightly over time with inflation, but point being, government do tinker both ends with rules and regulations which can affect someone's ability to transfer or how long it may take them to transfer. So what are the benefits of a QROPS or a ROPS? Your pension is able to be in the same country that you are in and retiring in. It can be denominated in GBP or AUD. 100% of your pension passes to your dependent if you pass away. The tax treatment from an Australian super fund is once you meet preservation age and you can draw on that super fund, it's 100% tax free. Whereas obviously living in the UK pension, as I mentioned, you will be the tax. So just touching on that bullet point about the 100% passes to your dependent, that does mean a financial dependent. It doesn't mean anyone who's your child can receive it. They can, but there can be tax implications for them if they are not financially dependent on you. But if you are in a relationship where you're financially dependent upon one another, then you can pass all of that across completely tax-free to that beneficiary. And even if it does move to a non-financial dependent, the tax is only on certain components of the fund, and it's at a pretty reduced or low rate of 17%. UK and Australian pensions, you can get your Aussie super and your UK funds all together, consolidated into the one scheme, probably depending on the fund size, an SMSF or the retail fund. So you can keep a close eye on what you've got and understand how it's growing, how you're invested, and not have a lot of life admin to worry about, particularly in your latter years when you may want to be out enjoying yourselves. QROPS responsibilities. So the scheme has to report back to HMRC for a period of 10 years from the date of the transfer, and ensure the benefits are broadly in line with UK pension rules. So as I touched on before, for example, you can't use a QROPS scheme with UK, you can't use the UK pension funds to buy a residential property. You can buy commercial property because you're able to do that in a UK scheme, but not residential property, which is one of the questions we get asked a lot. And yes, you must comply with the member payment provision period. So an example of that is that even if the fund, you've got the 10-year QROPS reporting period, but if you've been a resident of Australia for 10 years or more, you are able to transfer out of a QROPS in time, but one of those periods is a 5-year member payment provision period. So once the transfer has happened, it has to stay in the QROPS environment for a minimum of 5 years from the transfer. That's 5 UK tax years from the date of the transfer. Okay, the transfer process. So how do we operate? How does it work? Initially, there'll be you can contact us and arrange a no obligation meeting. Might be with myself or one of my colleagues. Within that meeting, we're able to determine if we can work together, if it's worth your while engaging someone like us. It will depend on the value of the fund. It will depend on the type of the pension. And your goals and objectives. But during that initial no obligation meeting, we're able to determine if it's suitable for us to work together. We will then start working on the transfer strategy. We will need to get the relevant information, not only from yourselves, but your pension schemes in the UK. We're able to do the analysis to determine if it's sensible to move your fund across, because from a tax perspective or flexibility perspective or guaranteed return perspective, whatever it may be, that is what the pension transfer analysis report provides, is our recommendation as to whether we think you should transfer that across and what are the reasons for that recommendation. that will give you the information you need to make an informed decision as to what you think you should do, as well as having our professional recommendation within that report. Beyond the report, if you wish to work with us to get the pension fund across, we can help you with that, and be very happy to. There's a lot of work to do in the process of bringing it across. So we're able to take all that weight off your shoulders and help you get it out of the UK over to Australia if appropriate to do so. Here's the case study for over 55s. So Janet is 60. She has a defined benefit scheme with a transfer value of $700,000. Janet wants to move her pension to Australia as soon as possible because she would like to access some funds to repay her mortgage. So she's 60. We haven't said here whether she has met condition of release, but she's met preservation age. Even if she hasn't met condition of release, she may be able to start a transition to retirement income stream, which is why one of the reasons she wants to get the money over here so she can start to repay her mortgage a bit quicker. So for Janet, we would move the defined benefit scheme into a SIP in the UK or a personal pension, depending on the circumstances and applicable to her situation. We then need to set up the QROP scheme in Australia, whether that be the retail fund or whether that be an SMSF. Then we're able to commence the strategy in line with the non-concessional caps, 360 plus growth if appropriate. And then once the money's over here, if she has ceased employment, she's able to withdraw that lump sum to repay the mortgage, or commence a transition to retirement income stream where she can access some of the fund to help repay her mortgage. And then hopefully she'll have a fair bit left for her retirement still. So those remaining funds can be invested in the QROPS superannuation scheme to hopefully provide long-term growth to give her funding provision for her retirement. Okay. So yes, why should you seek advice before you make any decision? Look, it's a forever moving environment. There's two jurisdictions involved. You've got HMRC and the UK government. You've got the Australian government and the ATO. It's forever a moving target. Things are changing all the time. And some of the things are positive, but some of the things are negative. And if you think you know what you can do based on today's legislation, if you're doing it in 2 years' time, it may well not be the case. So rather than making an expensive mistake, it's very sensible to get advice before making a decision. And not only that, are you actually better off by moving it, or is it more appropriate to leave it in the UK? If you do decide to do it yourself and were to make a mistake, HMRC can apply tax penalties up to 55% for a non-complying transfer. Confirming, and also making sure that it is transferable. Some schemes, if it's in the pension protection fund, for example, just simply won't be able to be transferred. Okay, I think it's over to you, Brenton.
Yep, back in. Thanks, Nick, for that. So the next bit around getting advice. So Nick's made a few points there around the importance of getting advice and why BDH Sterling, why we might be a good fit for that advice journey. Bit of background for BDH Sterling. We're a chartered firm in the UK, one of, if not the only UK pension firm in Australia with chartered status. We've got dual licensed advisors, so a couple of advisors in the team like Nick, accredited in the UK and accredited in Australia. And obviously we've got the pension transfer team as well, which sits in there. So we've got advisors in each jurisdiction and the ability to provide advice across both those jurisdiction boundaries. Defined benefit scheme specialists. We've spent a lot of time making sure that the knowledge, skills, expertise, and the advice we give in the defined benefit pension space is right at the top of where it needs to be. It is a massively complex area, like Nick's mentioned along the way, and we want to make sure that with the FCA regulating that people need to get advice for funds over $30,000, that we're doing that in the best possible way that we can with clients. We have, from a company point of view, BDH Sterling has been around for over 15 years now, just over. We celebrated our 15th birthday in July this year, and certainly been in this place, in the space, providing advice around pension transfers and making the best value of those pensions with your Australian funds for your future of retirement. Again, like we said, we do have offices across Australia. So we've got WA as our main office in Australia. We've got Sydney, we've got Melbourne, and we've got the office in the UK. So certainly people on the ground. And I do comment with people at times that we cover about 20 hours of the day with the time zone differences with offices being open, which is absolutely advantageous for us. So we can certainly help clients and prospective clients with that transfer of funds from the UK to Australia, or vice versa, for people who are moving back to the UK. And we certainly can do that from a transactional point of view with you, but we can see absolutely the value is the relationship with clients longer term as well. And that's really where we're geared up to make sure we're there for you, not only from a transfer point of view, but for advice into the future and the things which happen along the way as life stages change. A couple of the scenarios have going from a working life to a pre-retirement, transition to retirement, or post-retirement, significant events, and there's changes to what happens from a tax treatment point of view, access to funds. But how do you make the best use of what you may have from the UK and for what's in Australia to provide for those retirement lifestyle future goals? So we do that by giving the full complement of advice around Australian superannuation as well, around retirement planning, other sorts of investment strategies to protection strategies. And we also have a sister company in BDH Tax, which really does specialise in that UK to Australia tax situation and tax transition as it all comes through. So if you do want to have a talk to one of the team, certainly reach out, inquiries at bdhsterling.com for that initial conversation. Be with Nick or one of the other team members, one of the other colleagues there. When you send it through, it'd be great to give us a bit of an idea of what you're looking to achieve, ages for yourself and your partner, a bit of an idea about asset position as well, and a broad advice for retirement plan. What are you looking to achieve? What sort of timeframes? How do you see some of that playing out as it all goes through? So thanks, Nick, for taking us through the main contents of the presentation. It's now time to answer some of the questions that have come through. So a quick reminder for those wanting to ask a question, please feel free to type your questions into the Q&A section. We'll try and answer as many as possible in the about 15 minutes we have left. And if we don't get through all the questions, we will, as I mentioned before, come through and provide any specific answers back where we can post the webinar. So there are a couple of questions in there already. So Nick, we might start off on the first one, which came through relatively early on, which references if I was a higher rate taxpayer, from a tax perspective, would it be better to draw down initially from my ISA portfolio or SIP portfolio if I decided to become resident in Australia?
Okay, so if you are a permanent resident of Australia and a tax resident of Australia, the ATO don't recognise an ISA. So the ATO would tax any gains from when you arrived in Australia, or realised gains, I should say, from when you arrived in Australia to when that event occurs. So yeah, completely tax-free from a UK perspective, but from an Australian perspective, it will be capital gains tax on realised gains, and also tax on any income distributions within that ISA. So there's going to be a tax outcome from drawing from the ISA. With the SIP as well, as I mentioned, you'll get taxed at source in the UK until you apply for an NT tax code, a nil rate tax code. But Australia will also assess the income, and any tax that needs to be paid in Australia, you'll get a credit for what you paid in the UK, but any tax that needs to be paid in Australia on top of that, if there is any, you'll need to top that up with the ATO. So it's very hard to say. If you've got a cash ISA, then there's not going to be any realised capital gains, but there will be coming in from that. If you've got an investment ISA and you're new to the country and there isn't much in the way of capital gains, then yeah, it could be better to draw from that first. But look, it's very much based on the specific circumstances of an individual. So yeah, we'd need to look at what the position was and what your plans were and what you were trying to achieve to be able to give you the best outcome for you from a tax perspective and a flexibility perspective.
Yeah, perfect. Thanks, Nick. I might I'll jump on this one quickly, and then might have two or three which will come through to yourself. So, question is it necessary to take financial advice if the fund in the UK is over £30,000 or $30,000? £30,000 is the value amount for defined benefit pensions, and yes, it is a FCA requirement that you must seek advice from a suitably qualified financial planner with UK designation before you're able to remove those funds from the defined benefit or move them across to Australia.
I think there was a slight slip of the tongue there with you on dollars versus pounds. That's probably why the question came about. But yeah, honestly, yeah, easily done. But yeah, as Brenda said, it's pounds.
Yep, pounds. Or as Nick will tell me, the real currency.
Exactly.
One of the case study we had Nick in there when we spoke about Janet being 60 years of age. She could take out a lump sum to pay a mortgage, and just link that back to the 5-year period of it being in cure ops from a reporting perspective. Can you give a little bit of a insight into how Janet would be able to do a TTR but still be within reporting periods?
Yep. So once the fund is over in Australia, it is largely subject to Australia rules. So Janet is 60. She is able to either access or commence an account-based pension if she's ceased employment. If she's still working, she's able to start a transition to retirement income stream where she can access up to 10% of the balance of her super fund. Even if she's within that 5-year member payment provision period, that period of time doesn't preclude anyone from drawing from their Australian super if they've met preservation rules within Australia. So that 5-year member payment provision period, the biggest example I can give you of that is you can't transfer out of a cure ops to a non-cure ops in that 5-year period. So Janet can access her super, whether that be TTR or commence an account-based pension.
Perfect. Thanks, Nick. And are the UK government and NHS payments taxed as income in Australia?
Yes. Yeah. There is a allowance for the UK state pension. It's called an undeducted purchase price calculation. So you can get 8%, I think it is still, tax-free, but the rest is added to your assessable income, as would be an NHS pension or any pension that you have for that matter that is from overseas. So yes.
Perfect. Now, Nick, this is probably looking back on the 15 years BDH Sterling's been doing this, but for a client where the pension is only a relatively small part of their assets, do you want to give a bit of an idea of BDH Sterling's experience in advising on moving a broader portfolio of investments to Australia and maybe some of the ways which we're able to do that?
Yep, no problem. Sorry, can you just, so the pensioners, I've seen the question now. Pensioners are a relatively small part. Okay, yeah, absolutely. Look, we're UK financial planners and advisors, as Brent mentioned. I myself am qualified in license in both jurisdictions. So we understand the UK side of things and what the benefit might be of transferring your investment portfolio, closing down your ISA, for example, or if you've got a general investment account in the UK or a bond, whatever it may be. It doesn't have to just be a UK pension. But yes, we can certainly help with the repatriation of those funds, and look to set up what would be the most appropriate structures in Australia for you to benefit from the taxation system within Australia. So yes, absolutely, doesn't have to be pensions. It can be your entire situation that we will look at from a holistic perspective, appropriate advice of what to do in either jurisdiction.
Absolutely. And the only other bit I'd add to that is we've certainly got technical specialist paraplanning teams in both jurisdictions, which will work together to make sure that what we do in one is the right thing to do in another. So absolutely, those teams work closely together. Concessional and non-concessional contribution tax caps. This question, Nick, what happens if you exceed the NCC cap? What is the amount over $360,000 taxed at?
Yeah, this is a convoluted question to answer. The amount over the 360 is your over contribution, obviously, and there's a deemed earnings rate from the ATO. Don't quote me on this, it's around 11% is the deemed earning rate per annum. Even if you're sitting it in cash and not earning that, the deemed earning rate is the one that the ATO would apply. So every dollar that is over that amount is earning at the 11% rate. And then it does determine, the ATO, once they are aware of the over contribution, will send you a determination letter to say you need to get the over contribution out. It's this amount, and this is the amount that is assessable to tax. At your marginal tax rate, less the tax that you paid within super. So it gets quite difficult, and particularly with an SMSF, because the tax return is done in the past, if you like, we have to wait till the end of the tax year. It can take a long time for that determination letter to appear. So your over contribution could be in the super fund for somewhere up to 2 years potentially. So if you're making a huge over contribution, there could be some pretty significant tax penalties that you would incur.
Yep. It is a complex area, like what Nick alluded to there. We spend a lot of time on the research aspect beforehand with clients and their respective providers to make sure we understand what contributions have been made, or even up to the point of transfer on the Australian side of it. And that includes, we see at times that insurance policies provided as a benefit by the employer may be actually contributed in as concessional contributions as well. And like what Nick referred to there, it may take a year, 2 years before that actually flags up from an ATO point of view, post people doing tax returns, before it actually says that it's triggered a breach of the cap. So it's a complex area, and certainly one which fits in with that whole advice piece as well. Build on from that, Nick, the example of the DB pension with $750,000 of value in it. If PR was granted 10 years previously, how would the NCC caps work for that? And maybe the extension might be, what might that mean from roughly how many years for a transfer strategy to get that across?
Yep. So the date of arrival value, as we call it, is calculated from the 10 years prior, the physical day that you arrived in Australia. So if it's a defined benefit scheme, we have to work that back from the transfer value. If it's a defined contribution scheme, most schemes, not all, but most schemes will be able to provide us with that specific valuation. And it's based on the exchange rate when you, on the day that the transfer happens from the UK. So in that example, someone being here 10 years, the growth might be somewhere, and this is purely for the purposes of the example, but the growth might be somewhere between 20 and 30% of the value of that fund. So doing a quick calculation, was it 760 in the example? So the 760, yeah, well, 740. So 740, let's just say 20% of that is growth. That would be 148,000. That can come across. Then the rest is subject to the non-concessional contribution cap limit of 360. So we could then do of the remaining date of arrival value balance, we can do 360. And then that uses up your next 3 years worth of non-concessional contributions. So the balance remains in the UK, invested in Australian dollars if you wish. And then when the next, when your 3 years has passed and you have your non-concessional contribution limits refreshed, we could then bring the balance of the fund across for that period. So it would take 2 tranches to get Janet's money across if that were the growth element. If someone's been here 30 years, the growth's obviously going to be a lot more.
Perfect. Thanks, Nick. This one's a little scenario one, which we should be able to answer pretty quickly. If I had 3 UK pensions, one which potentially has to be paid in the UK, the other 2 likely to be able to move across to Australia, can you transfer them into my Australian super? The first step for that would be it needs to be into the CUROPS fund. So that would be a retail fund within Australia or self-managed super fund. So it would need to go into what is a recognised overseas pension scheme first. Post that, you then have the abilities, dependent on eligibility, age, those criteria, whether you can get the funds out of that environment, to look to potentially put it into your Australian super, but it would still be covered under caps and those requirements. So a little bit more of a complex scenario, and certainly one which we'd say, let's talk around what that might look like and what you can do, and then see what sort of steps would be involved to make that happen as well. So certainly sit on the advice path from that side of it. Nick, there's a couple of UK state pension questions in there. I might just go through a couple of them really quick. When can I start claiming my UK state pension if I've lived in Australia for the past 20 years and I'm 55 years old now?
Currently be 67, but there is proposed legislation to move that to 68. So yeah, it's a tough one to answer. Currently 67, probably 68, and maybe by the time you get to 68, it might be 69. So yes, a few years to go yet.
And if I'm due to draw on my NHS UK pension from March next year, I'm 60 years of age, I'm an Aussie tax resident, would I be taxed on the growth of the tax-free lump sum that I'll receive?
Yes, you will. That is taxed on the growth from when you arrived in Australia to the day that you take that lump sum. So there'll be no tax from a UK perspective, but the ATO will expect you to put that growth element on your tax return, and they will tax you at your marginal tax rate. So if you're still working, it can be quite an expensive exercise, and you'll have to get the growth worked out by potentially an actuary or a tax specialist. But it will be taxed in Australia, yes.
Perfect. And if you transfer across into a CUROPS fund, yes, can confirm that the money will still potentially grow like your Australian super fund would. Obviously depends on how it's invested. If you've got it just sitting in cash in an SMSF or a CUROPS fund, that'll be the reflective return, through to having it in more growth type assets. There's a few questions on fees in there. I think the easiest bit there is talk to Nick, talk to the team around what your situation looks like. We do operate more on a fixed fee. There's a few, is it fixed fee or percentage base? We do operate on a fixed fee. We'll certainly be able to talk to you around what advice on your pension looks like and whether it is possible to transfer to Australia or not, or would it be a withdrawal strategy from the UK when you're eligible. We can certainly talk to you about that, and anything that we do talk about as fees is given to you up front, so you know what you would be getting into. It is something which is based on, if you've got 3 pension funds, obviously you can imagine that there would be some additional for the other 2 funds, but certainly Nick and the team can take you through what that would actually look like from there. This is an interesting one, Nick. I might give this as a second last one just on time. How do you work out the growth of a defined contribution pension if you migrated to Australia 20 years ago and you no longer have records of that pension?
Yeah, good question. It's a tough one because it does happen. We use assumed rates depending on what your investment has been over that period of time. So it does get quite complex, but yeah, we use assumed rates that the ATO have told us in the past that they're comfortable with. But yeah, it's quite a difficult exercise, to be honest.
Perfect. And we'll wrap this up with the last one. If I'm 55 years old now and lived in Australia for 20 plus years, if I wanted to leave my pension cash in the UK, or maybe that's the advice, and draw on it now, how would that typically look if I don't have a UK bank account?
Yeah, so you'd be able to do that. The income would be taxed at source in the UK if you were drawing over the personal tax threshold. Even if you leave it in cash in the UK, the act of drawing it, if you're an Aussie resident, will also mean it's tax resident, permanent resident, will also mean that it's accessible to tax in Australia. So even if you don't remit the funds to Australia, the act of physically drawing it will raise the expectation from the ATO that that will be included income on your Australian tax return.
Perfect. Thanks, Nick. I will slot one more in. So I probably more read the first bit, which was a bit more around fees. The other scenarios in there was a friend who's a tax advisor in Melbourne suggested a couple of years ago that it was possible to transfer up to $1 million and pay 10% tax on the transfer to the ATO with future drawdowns then tax-free. Is that correct, or is that a older strategy not able to be in play anymore, Nick?
It sounds like the over contribution strategy to me, which is where you get taxed an unknown amount. But yeah, the tax rate a couple of years ago was 10% on an over contribution. Other than that, I'm not aware of anything like that. We're happy to talk about it in more detail if the individual's got more detail. But yeah.
Yeah, I certainly think it's probably one to reach out, because I think the concern that we would have and see at times is that active over contribution strategies put you at a bit of risk as a client as well, whether that is potentially seen as a breach of some of the Australian superannuation laws and whatnot too. So there's a level of caution, and sometimes there's things that, because you can do them doesn't necessarily mean that you should do those as well. So certainly one to reach out, talk to the team, give that scenario, and then see where that goes from a seeking advice path. Perfect. All good. All right. Thanks again, everyone who has taken some time out of their day today to attend. We trust the session information has been useful to you. Recording of this session will be forwarded to you over the next 48 hours, and we'll reach out direct if there are specific questions that we weren't able to get to. I'd also encourage you to keep an eye out for the survey, feedback survey as it comes out. Your time with that would be greatly appreciated and help us to formulate where we head with some of these webinars into the future. That'll come out from surveymonkey.co.uk. And for those of you who are looking to seek advice on what your situation may allow, please feel free to reach out to us at inquiries@BDH Sterling. Once again, on behalf of BDH Sterling, thank you for your time.